Imagine waking up one morning, checking your portfolio, and realizing the market has taken a nosedive. But here's the thing, it didn't happen overnight. There's always a warning, a pattern that repeats itself, year after year, crash after crash. Today, we're uncovering the one thing that always happens before a market crash, and why noticing it early could mean the difference between losing everything or seizing the opportunity of a lifetime. And no, it's not your neighbor selling their Beanie Baby collection. That's just wishful thinking. Stick with me, because by the end of this video, you'll not only see the warning signs most investors ignore, you'll know exactly what to do next. Imagine this, the market seems unstoppable. Every morning, the headlines shout record highs. Friends, co-workers, even your neighbor are bragging about their latest gains. Housing prices? Climbing faster than ever. Stocks? People are snapping them up like candy. The mood, electric. Euphoric. Almost intoxicating. But here's the thing, the market never explodes out of nowhere. It starts quietly. Subtle signs, tiny tremors, almost like an earthquake whispering beneath the surface. You might notice some oddities. Stocks priced ridiculously high, yet everyone keeps buying. People acting like logic no longer applies, driven purely by fear of missing out. That's your first warning sign, extreme optimism and complacency. People aren't buying because the numbers add up, they're buying because everyone else is buying. The herd mentality in full swing. It's invisible, yet devastatingly powerful. Ever wonder why, in the middle of a bubble, even your neighbor's cousin's dog seems like a stock expert? Funny as it sounds, it's not a joke. That's crowd psychology. When euphoria peaks, caution disappears. People feel invincible. And history? History is mercilessly repetitive. Think about it. 1929, the Roaring Twenties made people believe the good times would last forever. 2000, dot-com fever turned anything with a .com into gold. 2008, overconfidence in housing led to one of the most devastating financial collapses in modern memory. Every single time, the pattern is the same, optimism peaks, and disaster quietly waits in the wings. Here's the scary truth most people never see coming, they only realize what's happening after the storm hits. Headlines scream losses. Panic spreads. Millions are left scrambling, reacting too late. But here's your edge, because you're paying attention. You know how to read the whispers before they turn into a roar. You can act. Adjust. Protect. Even profit, while the rest of the world is still blinded by excitement. So, here's the question that matters. Are you going to wait for the headlines, or are you going to notice the tremors before the earthquake hits? The choice is yours. So, what's the secret signal? That invisible thread weaving through every major market crash? It's subtle. Quiet. You won't see it in flashy headlines, at first. But it's always there, lying beneath the surface, slowly building tension. That thread is credit expansion and excessive leverage. Put simply, people are borrowing more than they can reasonably pay back. Banks are lending with fewer questions. Investors are taking bold, risky bets with money that isn't even theirs, convinced the gains are guaranteed. And yes, that includes Uncle Bob maxing out his credit cards to buy surefire crypto. Don't be Uncle Bob. Seriously. This overconfidence in borrowed money is what inflates the bubble. Stocks that seem cheap? They're only cheap because debt is masking the true risk. Houses climbing faster than ever. Fueled by mortgages that, in any other world, would never be approved. The economy looks unstoppable until the tiniest spark ignites a wildfire. Here's the key takeaway. You don't need a Wall Street badge or a PhD in finance to see this. It's all about paying attention. Watch the headlines. Track debt levels. Follow margin lending. Notice risky financial behavior. These are the tremors before the quake, the whispers that warn the smart investor long before the crowd panics. And speaking of panic, that's where the story gets darker. Because when borrowed money stops flowing, when confidence cracks, The market doesn't just stumble, it plunges hard. Next, we'll uncover the signals everyone ignores until it's too late, the subtle warning signs that separate those who survive from those who get completely swept away. When the market finally begins to crack, the first signs are subtle, almost easy to dismiss if you're not paying attention. Unusual volatility, sudden stock sell-offs in sectors that seemed bulletproof, or economic indicators quietly flashing red. The world around you might still seem calm, but beneath the surface, tension is building. Most people panic at this stage. They sell in fear. They regret their earlier decisions. They watch opportunities slip through their fingers while the headlines scream about the crash of the century. But here's where you can gain your edge: preparedness. Ask yourself this: do you want to be swept up in the panic, or do you want to remain calm, even confident, when everyone else is running? This is the point where the wealthy separate from the rest. It's not luck, it's mindset, strategy, and timing. And the strategy isn't just survival, it's opportunity. While fear grips the market, smart investors are quietly positioning themselves for the rebound. They diversify their assets. They secure cash reserves. They even make calculated investments while the crowd is frozen with panic. Because here's the truth: when everyone else is selling in fear, value is often hidden in plain sight. Here's the truth most people never want to admit: market crashes are terrifying, but they're also predictable. And in finance, prediction equals power. Because the more you can recognize the signs before panic spreads, before the headlines scream and the red numbers fill the screen, the more control you have over your financial destiny. When you can spot those subtle tremors, the overconfidence, the rising debt, the quiet volatility, you are not just avoiding loss. You're doing something far more powerful: you're positioning yourself to thrive when the dust settles. You're not reacting to the storm. You're anticipating it. You're standing ready to step out stronger on the other side. And that's the mindset that separates the fearful from the wealthy. So here's what you do next: start observing the market with fresh eyes. Watch for extreme optimism. When everyone says it'll never fall, that's your cue to look deeper. Track debt levels, because when borrowing grows faster than income, risk is brewing beneath the surface. And notice volatility, those strange, uneasy movements in an otherwise calm market. Those are your whispers before the quake. Because the truth is, wealth doesn't come from luck. It comes from preparation, awareness, and strategic action. So if you want more insights like this, deeper analysis, real-time strategies, and alerts about the signals the market doesn't want you to see, hit subscribe and turn on notifications. Because your financial future deserves more than hope. It deserves strategy. Remember, crashes are scary, but understanding them turns fear into action. And action is wealth.